All right, what up, everybody? This is Jeremy with Escape Velocity Trading coming at you for another market bias update report for Sunday, February 2nd. Futures market just opened, and before we dive into charts, as always, we're going to look at our trading results from previous week. So here you can see the trades that I took ended up having 5 wins and 6 losses, ended up actually losing 7,412 and 50 cents. The far majority of that was a trade here on Bitcoin that got blown out of the water on Friday after Trump and his team in the White House announced tariffs against China, Canada, and Mexico. So not only following through on tariffs against China, which were expected, but also ended up throwing Canada and Mexico under the bus. And the market did not like that. So pretty cleanly on the futures charts, if we go out and actually switch to futures and look back to an intraday time frame, you can see exactly when those tariffs were announced at 10 o'clock on Friday, and it sold off hard throughout the rest of the day. And now on the futures market, we have actually gapped down over the weekend and are testing down into the lows around 59.50. So this is one of the reasons that I always prefer to do my own technical analysis on the futures. I know that futures are maybe a little bit more advanced for most people starting out. And so we are going to be doing our analysis on the S&P ETF. But just to point out, I want to show the difference here because right now on Sunday, futures market has opened. And so you can see the gap down in price here from the close on Friday, which came in at 6,065 and 50 cents. And now the current price on the futures, it gapped down to open at 59.82 and 25 cents and has actually sold down since then. Now, if we go out to the SPY and look at just the ETF, you can see the close on Friday here, but we do not show that gap down yet because obviously the actual stock market does not open until tomorrow morning at 6:30 Pacific Standard Time. So when I am doing my personal analysis, I like to rely on the futures charts to do that. But for everybody that is new to the market, we are going to continue our analysis on the ETF here. So going out and let's do these on weekly charts because the weekly charts are going to be really, really important for us right now. On the daily chart, if we drop back to that just real quick, you can see we are in a neutral range now over the last several weeks, basically going back to early November. We are now in this established neutral range. And the question on everybody's mind, therefore, is are we going to break out of this resistance line at about 610 on the S&P, or are we going to roll over and retest the lower end of this channel? So we know looking at the S&P futures, we have gapped down, and so we are actually trading right in the middle of that range right here. So to me, it makes more sense that we are going to continue to sell down and test this lower end of the range than we are going to break out on the short term. So unless something drastic happens in terms of tariffs and news along those lines that props the market back up, which in my estimation is not likely this coming week, then we are likely probably going to be testing the lower end of that range. So if we go back out to the weekly chart, we then need to look at this and say, okay, is this trend still intact? And if we zoom in, we can see that we really haven't done anything wrong yet. The 9 EMA, this green line, is still above our 20 SMA, the blue line here. And we want those shorter term moving averages to stay above the longer term period moving averages, signaling momentum. But we can see that the 9 is actually flatlining here, and it's basically been at the same level since 12/9. So the 9th of December, we started to flatline, and we've basically gone sideways with that moving average ever since. If this ends up starting to move lower and price breaks down, retests this lower end of this neutral zone, and breaks below that, at that point, this 9 moving average will likely have curled over and start to cross below that 20 SMA, which hasn't happened really since going back all the way back to September of last year, or excuse me, year before last. So we've had a nice long run of over a year in this bullish market condition. And this to me is signaling that we might have a localized top and we might need to decrease risk once again at the top end of the chart here. Going out to the triple Qs, you can see that this is basically the exact same chart. We can zoom in again and look at this. And again, we have the 9 EMA starting to flatline here. It has had just a tiny bit of a bump up, but we know actually that tech has been struggling on the daily chart. And if we toss that back to the daily, it actually looks a bit worse to me than the S&P 500 did. We have kind of this little descending wedge right there, as opposed to the S&P, which actually flatlined and pressed right up into resistance. In the triple Q, we didn't end up getting back up to this overall resistance level. So we have some weakness there starting to formulate. And this was really off of the DeepSeek knowledge off of China and worries that the semiconductor run and the AI run in the market might have gotten over its skis and might be leading to some more pressure in the market. So to me, I am looking to reduce exposure in the S&P, reduce exposure in the triple Q. And if we go out to the IWM chart here for the Russell 2000, you can see we do have a breakout channel here at about 230 and change, or we have a breakdown zone around 224 and change. So depending on which way this goes, that will signal to us where we want to trade. And to me, we can go back out again to the Russell 2000 on the futures, and we can see that we have indeed broken down here on Sunday on the futures market. So dropping back into the ETF, we are actually going to open somewhere down here closer to the low end of this range on IWM on Monday. So to me, that looks like potentially a topping pattern, maybe a little messy head and shoulders pattern here. If we do break down, we would probably end up then breaking this 50-period moving average, and the next stop would be back down to around 200. And 200 has a really, really strong support zone here, so I'm not super worried about price going below that. But to me, this is starting to look more like a bearish retracement where we moved higher, set a low, came back up and set a lower pivot high, and then might potentially roll over to the downside once again. So that is my base case on IWM. Going out to Dow Jones, same kind of thing here as the triple Q. Instead of getting back up, well, we basically did get back up to resistance here. So actually similar to the S&P instead of the triple Q. So it came up, dinged almost to the penny on that, and now rolling over. Again, if we go back out and compare this to the Dow Jones on the futures chart, and look at the daily chart on futures, you can see we are in fact rolling over and kind of did a double tap on this overhead resistance. So this might be the start of a formation of a double top pattern, which is a reversal pattern. And if this actually holds, we won't know for a couple of weeks probably. But if that does hold, this would then potentially be the start of a longer term downtrend. So it really depends on what happens over the next couple of weeks. The next couple of weeks price action is going to be very, very important to see where these kind of price points end up going. But keep an eye on it, and the name of the game this week and next week is likely going to be decrease your risk. Going out to IBIT. IBIT on the weekly chart, we haven't done anything wrong. Again, if we go out and look at Bitcoin's actual chart and drop into a daily chart, you can see that we are down below all of our moving averages on the shorter time frames. And that is not a great look. If we do break down here, we do have a diagonal support level underneath us that would hold up at around 95,000. But below that, we might be testing back down to 90,000 within a pretty short time frame if this does not recover. So to me, de-risking in Bitcoin as well is prudent. Going out to Ethereum. Ethereum has a bit of resistance here between 2630 and 26, let's say 70 on the Ethereum ETF that I track, ETHA. If Bitcoin and the rest of the market roll over, it is going to be very, very difficult for Ethereum to break out. So again, instead of a breakout, my analysis here is rolling over and potentially going back down to retest the lows down around 22 or 2250. Now, going out to our 11 major sectors, starting off with basic materials. Here we did have a potential for a high base breakout, but if we draw this out to a weekly chart, this could very easily turn into a breakdown below the lows and therefore a bearish retracement instead of a breakout here to the top side. Now, on the weekly chart, we can also see our moving averages here decreasing above here, acting as overhead resistance. So to me, it makes more sense targeting the downside on this chart than it does trying to play a breakout, because even if we got a breakout above the consolidation on the daily chart there, we would have our moving averages on the weekly chart right above us, acting as overhead resistance. Going out to discretionary. Discretionary is not doing anything wrong. It's holding up okay. It is overextended on the weekly chart. And if we drop this down to a daily chart to kind of check it out, it has just had a really hard time building momentum to the top side. Even though we did find support and held support on this 50-period moving average, I am suspecting that we are going to see breakdown on consumer discretionary here before too long. So I am more interested in setting an alert here and being notified by the market if prices break down below that level and potentially looking for a shorting opportunity than I am anything else. Going out to XLK. XLK, we are now in a very neutral, choppy range. We have been really ever since about a year and almost a half ago. Haven't really gone much of anywhere on XLK. And if we toss this out to a weekly chart, or excuse me, a few months ago, not a year and a half ago, about half a year ago. And if we toss this out to a weekly chart and we zoom in a little bit, to me, with everything going on, not only with tariffs, but also the DeepSeek stuff and just the market in general being over its skis a little bit, I do think this has more of a lean to maybe slightly bearish than neutral at this point. Technically, the chart still is showing neutral. But my personal bias here is that the tech sector in general has gone a little bit further and faster than it could sustain itself and is likely either going to chop sideways or roll over and go slightly lower. Going out to XLE, we are breaking down below our clustered moving averages here. Again, we have the 9, 20, and 50-period moving averages stacked all on top of each other. And if I zoom in on that, you can really see all three of these moving averages clustered right there. We tested to try to get back above them last week, failed, and then sold off decently aggressive. Next stop down to probably about 82.50 to the downside on XLE. Going out to XLU. Dropping this to a daily chart for our analysis here, we did have a nice consolidation period right on the 200-period moving average. On the daily chart, we broke back above all of our moving averages and then failed to hold that. And now we are just kind of in this messy, choppy zone where it is going to be hard to get much of a read one direction or the other on this chart. So I'm not even going to try. I'm just going to say this is a mess and a stay away. Going out to consumer staples. Consumer staples, if we can recover back above $80.24, we would have potentially a shot at going up back up to this daily diagonal resistance at about 82.50. To me, the more likely scenario is a rollover here and retest of the lows down to about $76. Going out to XLC. XLC, we are potentially hitting a double top here as well. If we drop this out to a weekly chart, we are overextended on the RSI on both the daily and weekly time frame. And to me, it makes more sense to come back down and retest the 20-period moving average. And if that fails to hold, retest the 50-period moving average down below us. Going out to XLI. XLI looking like it might be wanting to roll over here as well on the daily chart. This is basically going to just be a simple bounce of the 200 and a come back up, establishing this diagonal resistance line. If we can break back above that diagonal resistance, the tip will be back to the bulls. But again, this is looking more bearish to me than anything else when combined with the weekly chart. To me, this is a lower pivot high, and I am assuming that we are coming back down and testing the 130 zone around the rising 50-period moving average. Going out to XLF, pretty much rinse and repeat the exact same thing, potential double top. Going back down to the daily chart, looking at this, we are overextended on both the daily and weekly timeframes. To me, this looks like it is more likely to roll over and retest 50 than it is to break out this week. Heading out to healthcare. All of these charts are looking almost identical. Again, a little potential high base on the daily chart, but if we toss this out to a weekly chart, this is signaling potentially a lower high pivot. And again, if that is the case, if we break down below the low of this candle, which was 144.97 cents, then the lean has to go to the bears, and we would be coming back down to test somewhere in the zone of about 140 down to 135. Going out to XLE. Clear these drawings for us. XLE looks okay in terms of the bounce on support. So we have kind of an important support level here. We did break out above that, came back, and are sitting just above that zone. But if we drop this to a daily chart, this doesn't look particularly great to me. It looks to me like a lower pivot high, and the more likely case is going to be a rollover to the downside than moving higher. Going to gold. Gold attempted to break out on Friday, did technically confirm above our previous pivot high. We are above all of our other moving averages, and our moving averages are going up. The one caveat to this chart is the US dollar, which we will get to in a second, is showing a lot of strength, and it is usually hard for materials and commodities specifically to break out if the dollar is showing a lot of strength. And so right now, the dollar is going to have an impact on both gold and our silver chart right here. Silver did have a nice little breakout with momentum, confirmed higher with a gap up, and now is just kind of sitting above that channel. And finally, if we go out to the dollar, the US dollar here is looking like it is trying to push higher. And if it confirms here and moves above 108.60, the next stop would be pushing back up to 110 or just above, and that again would put pressure on equities and the commodities market. Finally, let's go out to our heat map. This is a 1-week performance looking at the percentage gains and losses from last week's trading. Again, you can see a lot of negative numbers in the tech-heavy sectors, especially in the semiconductor space and AI names. Also seeing a lot of red in energy. If we toss this out to a 1-day performance, and this is looking at last Friday, again, you can see big losses in semiconductors and a lot more red just all over the place, showing that selling being more widespread based on the tariff news that came out on Friday. Last but not least, let's finish up by going out to Forex Factory and looking at the economic calendar for the week ahead. We have economic reports on every day of the week this week. PMI data on Monday, JOLTS job openings Tuesday, PMI data, ISM services PMI data, on Wednesday, unemployment claims Thursday, and then Friday, unemployment rate, farm employment change, and hourly earnings month over month on Friday. So a lot of economic data coming our way. With that, guys, as always, trade safe. Let me know if you have any questions. Hit me up in the comments, like and subscribe if you haven't already. Really helps me out, and I will catch you next week.